A lot of investors do consider the current environment similar to the Roaring '20s, and it's understandable. We've had an incredibly strong rally. We see probably the best economic growth numbers we'll see in a lifetime, or certainly we hope we see in a lifetime. But we're reasonably far advanced from a reopening standpoint. Markets currently, over the very short term, are very supported by internals. And what I mean by that is volatility continues to fall across key sectors, small caps, tech, industrials, energy. Cross asset volatility continues to be very much supportive of equity fundamentals. So I think on the very short term, equity markets are in good shape. That said, it's clear that we're going to have a peak in industrial growth later this year. Uh, just as we're starting to probably start to see industrial rate of change or rate of improvement peak, we're still going to see strong growth out of the services side of the sector of the economy. The key is going to be, is it going to matter? And unfortunately, I think we're going to start to see some of the slowing or peaking in industrial activity over the more volatile summer months. That may introduce a little bit of market volatility. But what's going to be really important is, where are we as we exit the fourth quarter? Are we still on a sustainable growth path? Can we continue to upgrade earnings into 2022? And if so, equity markets are going to be fine. If not, we'll have to digest some of these gains. We'll have a little narrower markets, but I don't think we're set for any significant downturn just yet. Infrastructure is going to be a key part of really economic growth well into the future. And it's important for one primary reason. Our federal government and its level of spending is the marginal growth for our economy for the more medium term and even potentially into the longer term period. But when we talk about infrastructure, I like the way the Biden plan is broadening the definition. I understand the concerns for those libertarians out there of federal encroachment or big government, but the truth is that's just where we are because of policy choices we made 10 years ago plus. We need this support, and we really need to get the support to middle class Americans in order to support economic growth. And a lot of the initiatives that are being discussed certainly will boost some of that real income that, quite frankly, the private sector hadn't been there to support wages and growth. And so we need that. As it relates to the more traditional infrastructure spending, we need it. We've needed it for over a decade. But when you see big numbers of $1 trillion, keep in mind those are going to play out over 10 years. And even if we pass this infrastructure bill later in the third or fourth quarter of 2021, those funds really won't begin to hit the real economy till well into 2022. So from a big short-term impact, would I rush out and buy companies that manufacture road equipment or paving or things of that nature that people associate with true infrastructure? No. It may support and provide some underlying strength into 2022 and beyond, when they would probably be on the downhill side of a recovery. But I don't think it's going to be a significant needle mover over the short term. I do think it is critical for the health of the U.S. economy.